Live here, right? Are we live? Okay, so this is my first live stream, so I don't have the ability to edit. You get to see all the blunders live, so welcome. This is the first live stream we've done. So let's talk about the banking crisis. We've had a lot of questions on the site on the channel about the banking crisis and what happened last week. So what happened last week is as the collapse of Silicon Valley Bank, or SVB, caught investors by surprise, the S&P 500 lost 4.5%. The Dow slid 4.44%. The NASDAQ composite decreased by 4.71%. And then on Sunday, the Fed Treasury Department and FDIC announced that Silicon Valley Bank's depositors would have access to all their money on Monday with no losses associated with the resolution of Silicon Valley Bank would be borne by the taxpayers. So that was good news. I think they're trying to calm the storm before big problems happen, and calm the public. So the Fed will make additional funds available to banks through a new bank term funding program that will make loans up to 1 year in maturity to banks that pledge high quality collateral assets such as treasuries and mortgage-backed securities. And there's a reason for that. And the big reason for that is because a lot of these banks are doing what was safe at the time. They're investing in these government bonds, super safe. But the problem is that the government bonds back then, they were paying pretty small amount, pretty small interest rates at the time. Therefore, they became very, very illiquid. And so, and we'll talk about that a little bit. And by the way, it would help me out if you can please click the like button and subscribe if you haven't, so you can keep up to date right away. 3 things to know. A large failure, number one, of the 3 things to know. The Federal Reserve, Treasury Department, FDIC took unprecedented steps on Sunday evening, most recent Sunday, to ensure access to deposits as the 2 lenders that failed last week, that's Silicon Valley Bank and Signature Bank. There's also Credit Suisse Bank in Switzerland. So they've drawn the line. Regulators will not, the regulated banks will not default on deposits. So to calm the panic, policymakers' actions should forestall any further U.S. bank runs, because if they hadn't, there'd be runs on banks all over the country. And so institutions that had similar balance sheets, as well as regional and smaller banks, could be impacted if deposits flowed out of their banks and upwards to the big banks. So the cost of making the uninsured depositors of Silicon Valley Bank and Signature Bank whole will be a levy on the banking industry. So they're going to have to up the insurance premiums they have to pay to FDIC. Now, among avoiding a much wider panic is in the country's best interest and well worth the cost. While we expect these things to not have a major impact over the long term, it's making people a little scared in the short term, and it's not clear if the 2 banks are the sole institutions that will be resolved by the regulators. If there's other banks that may be in similar situation. So in my view, these recent events underscore the unanticipated weaknesses caused by the Fed's rapid rise in interest rates, the quantitative tightening, and the impatience with inflationary pressures after Silicon Valley Bank had super safe investments. They made the safest investments they could at the time they made them, mostly U.S. Treasury bonds and mortgage-backed securities, and the average return is 1.79%, which when they made them, that was kind of the going rate. And the ones they held on to, they had an average maturity of 4 years. So there's 2 ways to get rid of these bonds. One, they can wait till the bonds mature, and the government will pay your principal and the interest, or sell the bonds to somebody else before the maturity date. And the bank could not have reasonably anticipated the fastest interest rate increase in U.S. history. I mean, rates have never risen at a more rapid pace than right now. So now you can buy U.S. Treasury bonds that pays nearly 5%. So nobody's going to go buy these 1.79% bonds from Silicon Valley Bank if they need. If the Silicon Valley Bank needed to sell them to generate cash quickly, they're not going to buy them at face value. They're not going to pay $100,000 for that low interest return. So they'd have to either wait until the bonds mature or sell the bonds at a huge loss in order for the buyers to end up getting their 5% return the investor could easily get right now anyway just by buying the bonds directly with the government. Here's an example. You buy a $100,000 bond from the government. It pays you 5% interest or $5,000 a year. And somebody else has a couple of $100,000 bonds they bought last year that pays 2.5% or $2,500 per year each in interest. So if an investor had $100,000 to spend and wanted the same $5,000 in annual income, he would now have to either buy a new 5% bond directly from the government or buy two of those older $100,000 bonds at a $50,000 discount each. So these two older $100,000 bonds the investor bought would pay $2,500 each at 2.5% interest each for the older bonds. So they'd have to buy two of them to get the $5,000 return. Now, when the bonds mature in 1 year, those who redeem the bonds not only get the interest, but they get the $100,000 principal back. So the discounted sales price is not going to be exactly 50%. But the one selling the lower interest range bonds before maturity would lose money because they'd have to sell them at a discount. So that's the bugaboo that Silicon Valley Bank was in. Now, the U.S. banking system is healthy. Panic can be, very, very potent, especially with social media. And so the overall U.S. banking system is much more strongly capitalized than it was, prior to the 2008, 2009, the crazy economic times here. And U.S. regulators have been preparing for this moment since that global financial crisis we had. Now, all U.S. banks, and particularly larger ones, meet the strict capital requirements and have to undergo several annual stress tests by the regulators to make sure they have enough cash on hand. So that does not mean every bank has been wisely and prudently managed. And even if depositors are protected, it doesn't mean the same for bank equities. That is, the bank's stock price, which I learned, thinking I was buying Credit Suisse and First Republic Bank at the bottom, and then only to see the price cut in half the next day when UBS secured a deal to buy Credit Suisse for pennies on the dollar. I mean, they got a steal because I think the capitalization of Credit Suisse at the time was like $9 billion, and they bought it for like $3 billion something. So fortunately, I'd only invested a little bit of money in these two stocks. So other actions taken by the Treasury and Fed will help banks with a new 1-year lending policy called the Federal Term Funding Program, which allows the banks to receive loans to bolster their liquidity. So that's an important an important feature is they will receive a credit for pledged Treasury and mortgage-backed securities at par value, rather than a price that has potentially been deflated by the Fed rate hikes in this past year. So we talked about having to sell these bonds at a discount in order to get the same return. Well, the Fed is going to okay, we understand you've been hurt by these rising interest rates, so we're going to lend you as if they were at face value and didn't have to be sold for a discount. Okay, this is of course comparable to the price if they had held it to maturity, and so it can limit the market-to-market losses for banks with these fluctuating interest rates and the bonds paying different higher interest rates now. So macroeconomic policy is partly to blame. Many have gone out of their way to note the highly unusual business model of Silicon Valley Bank. And this is true still. U.S. macroeconomic policies bear some of the blame for these events, namely the Fed raising the discount rate they set as an interest rate the government charges when it lends to banks. Now, U.S. Treasury Secretary Yellen noted that rising interest rates used to combat the inflation, in part by excessive liquidity used to support the economy over the pandemic, was a core problem for Silicon Valley Bank. Its assets, including bonds, mortgage-backed securities, and loans made to venture-backed companies, had mark-to-market losses in the face of rising interest rates, like we just talked about. The value of the bonds, what they'd have to sell them for, would have to be discounted in order to get the same return bonds are paying now. So fiscal and monetary easing was drastic, as you know, in 2020 and 2021, the pandemic. I mean, the Fed just dumped money into the system, as you know. And the Fed policy was tightening in 2022, was equally drastic as the money dumping. So the tightening has been, just as rapid as the money dumping. And so the Fed stress tests never included scenarios of rapidly surging interest rates. So that wasn't thought out into the regulations to require banks to keep sufficient reserves, liquid reserves. So stemming an unexpected confidence crisis that will not stop the U.S. economy from slowing down in the months ahead. So this is going to affect the economy. And the shaky ground that bank investors feel and the actual economic slowdown to come should help Fed officials see that their hiking cycle is nearing completion. Let's hope, right? So this is even as they hope the latest liquidity boosting steps for banks will allow them to keep monetary policy and bank regulatory policy separate. That is, they just made it easier for banks to borrow money from the government just now. And at the same time, the regulators are going to be all over these banks to make sure they're keeping enough cash reserves. So that's kind of an update what's going on because I've gotten a lot of questions on the channel, a lot of interest in that topic. So wanted to cover it with you. So please like, subscribe. This is the Business Guy.